that brings then another set of problems for the Fed. So short term, I don't think they will increase rates because they must be concerned, as well as the Treasury, about the commercial real estate market, which in the US is a disaster. I mean, I've cited in a recent report, which I wrote, about commercial properties that were sold in Los Angeles and in San Francisco, and they were sold at 50% or more lower prices than they had been sold in 2018 or 2014. Some of the buildings were old. Okay, that there's some depreciation charges that one would have to consider. But it's still unusual to see a property market that is as large as commercial properties in the US decline by that much. Never happened before. So they are concerned about this, and their main concern must be that residential prices would come down significantly, because the typical American, he has probably, depending on the household, but the people that have some wealth, say 3-5 million, they probably have about 2 to 7 million in residential properties which they occupy. So if that would go down in price, it would cause significant damage to the financial condition of individuals. So that they don't want to destroy at the same time that the commercial properties are destroyed. And then we also have to see the pension funds own a lot of commercial properties, and the pension funds, especially the ones run by the government, they are underwater like crazy. They have unfunded liabilities like never before. So the Fed, even if they wanted to increase interest rates, I think they would shy away. They're not in a hurry to cut, but in my view, the global economy is in recession, and also the US, if properly measured. You know, if you just say you earn 5% more, but your cost of living is up 7%, then inflation adjusted in real terms, your salary has gone down by 2%.
Yeah, that really leads me to the point of, okay, so let's say the Fed doesn't cut, but what if, because as far as I know, the banks are still in trouble. Especially the regional banks are still in trouble. So work that out for me, or let's game that out. What happens there then if the Fed doesn't cut? They're just going to let these banks go belly up?
Well, no, they can support the banks. They can make liquidity available to failing banks. They can also take them over. So there's a lot of things they can do.
I guess they start quantitative easing again if they haven't already.
Well, that's a good question. If they haven't already, in my view, and this is a contentious issue in economics, whether by increasing interest rates you actually tighten or not. Because if you look at a country like Turkey or Argentina, they have interest rates of around 100%, but money is not tight.
Right.
You understand? The absolute level of interest rates does not tell you anything about money being tight or not. I can say this: if money is tight, the symptoms of tight money is a stock market that is not at the new all-time high. Number two, if money is really tight, the spread between treasuries and junk bonds or triple Bs or triple Cs or high yield bonds widens significantly. If money is tight, the volatility index shoots up. At the present time, it is at an artificially or relatively low level. So that tells me, and if money is tight, you don't get speculative excesses, but we see every day some stocks jumping up 20% or down and so forth. This kind of behavior in markets does not indicate tight liquidity.
Got it. So your biggest indicator for tight liquidity would really be where our asset prices or where's the stock market really?
Yes. I mean, if money really became tight, I tell you, from this overbought condition in the market would sell off rapidly. But money isn't tight. I see it myself, and I want to explain why money isn't tight. You see, you take my case. I run a business. Marc Faber Limited is based in Hong Kong, and I have large cash deposits because of the nature of my business, and I need reserves. Now, until 2 years ago, a problem for my business was that I didn't get any interest. The interest were below 1%. So I remember we put on deposits some funds at 0.5% interest. Now I get 5%. So say on $10 million, before I have no income, now I have $500,000 income a year.
Just on the deposit.
Yes, just on the deposits. And take me wrong, I don't regard deposits to be very safe. Otherwise, I would have everything in deposits. But I think there is a danger to deposits, and I've seen this danger in other jurisdictions. The last crisis with deposits that was obvious was in Cyprus a few years ago, when people lost all their deposits except $100,000. So I'm reluctant to have all my money on deposits. But otherwise, I don't think stocks will have higher returns in the next 5 years or so. I think rather that stocks will continue to drift. In other words, you can have 10 stocks that go up, like the FANG-related stocks or the Magnificent Seven and semiconductor stocks. But the rest of the market, and I have a diversified portfolio of stocks in Europe and in Switzerland and in Canada and in Latin America and in Asia principally. But in general, for the last, say, 18 months, my stock portfolio hasn't done well. It's not been a disaster. Don't misunderstand me. Some stocks have gone up, but for every stock that has gone up, another one has gone down.
And would you attribute that to deflation or stagflation, global deflation, or just, what would you attribute that to?
To one and only reason, to the governments who impose more and more regulations on corporations